Great. Well, thank you, everybody. So my name is Ben Isaacson, and I am in strategy at the Clearinghouse and have been leading our work on digital assets. And really, thank you for coming. Today, we're going to be talking about digital assets, focused on where they're valuable and for which use cases, and where they may not be valuable. Approaches the market's taking to act and react in the digital asset world, and where do we see the market going and how we can prepare. Before we start, I'll let Jack introduce himself, and then we'll start the questions.
Yeah, thanks. Jack Poodleroy. I'm part of Swift. I've been there for 5 years. I run our digital asset strategy business. I've had roles across our innovation and strategy team, always looking at blockchain, digital assets, and tokenization. Thanks for having us.
Great. So let me just start with a question for you, Jack. Given that there are already many ways to make payments, both globally and domestically, what are the gaps in the market that you're seeing that digital assets, may be able to address?
Yeah, I think it's a really good question. And before we even talk about digital assets, I think we need to kind of pay some credibility to the efficiency of the market it is today. Right? When we think around payments at scale, banks are moving trillions of dollars across countries, across currencies, across time zones every single day. The thing is, I think this is still a sequential process, right? And so every single payment, every transaction, step by step, is going through a set of institutions, through different systems, and that is happening on a very kind of sequential basis. I think that design works really well, and it's obviously predicated around risk and control and resiliency. But I think when you start to look at some of the more complex cases around cross-border transactions or cross-system transactions, the level of coordination required to actually manage or facilitate these payments is something that is maybe not as efficient as it could be. And so today that's managed through the likes of messaging, of liquidity buffers, daylight overdrafts, et cetera. And I think banks largely have this really efficiently managed. But I think when we talk around what can digital assets and tokenization do beyond that, is really around coordination, right? So not thinking about digital assets as a new form of money or a new form of value, but as a way of coordinating and executing the exchange of information and value in a more efficient way than exists today. And so I think there's different ways when you think around using tokenization, you can start to coordinate transactions across these different participants in a kind of more atomic way that will allow us to manage liquidity more efficiently, to manage risk a bit more effectively, and overall kind of have a more seamless transaction experience. So I think there's opportunities from an institutional standpoint around how tokenization technology can be used. But I think fundamentally this effort that we've had for a number of years around aligning the data, the value, the payments, all the different systems that a payment needs to touch. And we were talking about this before. I think it's something that it's been a bit of a holy grail for some period of time. So maybe a question back to you is this new technology just maybe a new mousetrap that can address that? Or do you think it's, I don't know, do you see it as something else that it can provide beyond that?
Yeah, so I think that, again, that notion of kind of marrying payments, data, and kind of business processes in one kind of in one common infrastructure is the holy grail. And it's something that, when I started in this business, it was the same problem, right? Folks were looking at a lot of the same things, so it's not a new problem. So the question is, can this do it better? I think there are probably two answers to that, right? So one is, first of all, it's too soon to tell, right? So there's components of it which are quite helpful. So whether it's a shared ledger, so everyone can see the same information at the same time, is very important. The fact that there's programmability, or the ability to have smart contracts where payments are conditional on other processes, start to look like process improvement. But then the third thing I'll say is that what we're kind of seeing, and we've seen this before in kind of the history of payments, is anytime there's new participants coming into the market, they tend to bring new technology and new ideas. And some of those ideas actually provide improvements that aren't necessarily feature functionality, right? It's improvement in customer experience. It's more flexible access to the payment systems. It's, it is process improvement. And those are all things that incumbents tend to work on incrementally, right? Once you've kind of built a stack or built a backend, you tend to improve things a little bit at a time. But when new players come in, they try to improve them drastically, and that often kind of makes big changes in the market.
Yeah, I think that makes sense, and we're clearly taking already a very kind of digital money or payments-centric view to it. But we also, when you look at the capital markets across the board, there's different use cases that there's maybe even more potential benefits in terms of the efficiency that it could gain. And so I think there's also that kind of intersection where you have kind of tokenized assets on the security side of things, coupled with a tokenized kind of payment form or tokenized form of money that can actually make some of those benefits even more meaningful. And maybe that's a good kind of segue into a second topic is just around the different kind of tokenized forms of money, a little bit of a landscape view in terms of what's actually out there in the market. I think we're all seeing the news, stable coins are in basically nearly every single article that you're reading about. Banks are increasingly looking at tokenized commercial bank money, tokenized deposits, or deposit tokens. But there's also different use cases that are kind of, I guess, kind of picking up. I mean, what are you seeing from your standpoint in terms of where is the most traction and why does it matter in terms of the actual form of money itself?
Sure. So I think when you look at where digital assets and kind of stable coins started, and it's really where most of the volume is today, it's in facilitating the trading of digital currency. So if I'm a consumer and I have a Bitcoin and I want to sell it and buy an Ether, the best way to do that is through stablecoin, right? Rather than having to actually cash out for real money and then use that real money to buy the new coin. That's where the majority of the use is today. And that sounds probably like something many folks in this room don't touch, except maybe in their personal lives. But I would say there's probably two important pieces to that majority use case, right? So number one, it provides a really nice economic structure for the issuers of these stable coins to earn money and therefore improve and innovate their services, right? So just as an example, the two largest stablecoin issuers made over $1 billion last quarter just doing that. And so I think that's really important. But the other point around it, which I think is important, and it gets back to the comment, Jack, that you made earlier, is around that same applicability to capital markets, right? So if the digital currency world has proven that you can tokenize an asset and then facilitate the trading of that asset more simply through a stablecoin, you start to see that in capital markets of, well, what if other assets can be tokenized? Is on-chain the best way to facilitate the clearing and the exchange of those assets? And so a lot of the early excitement we've seen in probably the world that's a lot closer to where we all live is in that space. So I think that's one key use case. And then the second key use case we're seeing today, like in real volume, is the movement of U.S. dollars to markets where U.S. dollars is, kind of a rare commodity or hard to get access to. So it started probably on the consumer side with remittances. I have a relative in Latin America, and that market is experiencing a lot of inflation, and we want a U.S. dollar, but getting U.S. dollars in those markets are hard, right? So you're seeing a lot of that as an early use case, and again, that probably feels like something that not a lot of people in this room would be that interested in. But where, again, the analog that I would point to is think about like B2B supply chain, right? And if you are in a market, if you're a buyer in a market where US dollars are a scarce resource, what we're starting to see people come to our banks and ask for is, hey, will you accept a stablecoin instead? Because it's actually easier to get U.S. liquidity through a stablecoin than through my typical, in-market structures. So I think those two things are really kind of the biggest today. and kind of manifest in what we're starting to see the growth of is B2B use cases, capital markets, and then inside of big companies, liquidity management across different legal entities.
Yeah, I think fundamentally, you talk around some of the use cases on the capital market side that are live today. You have a lot of asset managers that are tokenizing money market funds, and they're very much focused on enabling the use of stablecoins as a means of settling subscription redemption types of flows. I think the reality is, for the most part, there's not any really forms of on-chain cash other than stablecoins that are even available right now. So there's clearly a desire from a utility standpoint to enable a form of on-chain cash. And obviously some of the larger banks are now kind of out in production with tokenized deposit types of capabilities, or even kind of deposit tokens. There's a slight nuance there. But fundamentally, those are not really interoperable with each other today. And so they work really well within the walls of their institution. But obviously there's kind of a whole network aspect that's kind of missing there. In any case, I think we're still early, and the different players are starting to bring different forms of on-chain money, tokenized money, that can be used in a 24/7 kind of programmable, automated way that will actually solve some of these other use cases, whether it's related to money market funds or DVP type of settlements, or even, as you mentioned, some kind of B2B treasury management, which is obviously something that's probably relevant for many of the institutions in this room.
No, I think that's right. And there's two things I'd like to unpack based on what you said. So the first is around some of these basic core features, right? So when you think about some of the problems that digital assets can solve, right? It's that notion of 24/7 money movement. So we all know wires are today 21/5, and they're global. So there's many markets. When you think about time zones, you think about different market practices where U.S. dollars aren't received exactly when the recipient wants them to be. And then in the US, at least, RTP is 24/7, but it's domestic. And so when you start to look at some of these global problems, you start to see a need for that. Then the second thing I'd want to unpack is you kind of brought up this notion of, tokenized deposits versus stablecoin. So it's probably worth spending a minute just kind of speaking about some of those key differences. So first of all, when you think about stablecoin, it's issued centrally. So there's one issuer. So think Circle, Tether, folks like that. The other piece around stablecoin is it's pre-funded, right? You have to buy stablecoins, and that's a very different dynamic, and especially for banks because it's off balance sheet, so you can't lend against it. So those are kind of key important distinctions as banks think about it, and then you contrast that with tokenized deposits. Tokenized deposits are also a digital asset. However, what's different is banks, it's really a tokenized version of a bank deposit. So banks are allowed to lend against them, which obviously is important. I think I saw the other day that about 55% of all bank revenue is lending against deposits. So that's pretty important. The second piece around it is because it's based on deposits, all the existing legal, regulatory, operational frameworks that the industry has built around deposits all work the same way. And when you think about all the work that's going to need to be done to sort out the global regulatory structure of digital assets, at least starting from a place where it looks a lot like it does today, will probably be very helpful in terms of scaling.
Yeah, maybe one other final piece, because I think you talk around the attributes or characteristics of the different instruments, and I think that's key to have an objective discussion. The one other piece that is often talked about in the industry kind of widely, whether it's by the stablecoin issuers or otherwise, is just around settlement, right? We talk around the term settlement is thrown around quite loosely. And I think there's different levels or different layers of what settlement actually means. And so we're saying something is settled. A central bank might say, we're only going to think something is actually considered settlement when it actually is anchored and settles in central bank money. But fundamentally, when you have a cross-border kind of payments that's done through correspondent banking rails and relationships, there is an element of settlement in commercial bank money that's taking place, because obviously central bank money is inherently jurisdiction specific, right? You're not going to be settling with a central bank money outside of that particular jurisdiction. When we talk around stable coins, people are saying, okay, well, you're basically transferring a stable coin from wallet A to wallet B, and therefore it's settled. I think from a technical standpoint on a blockchain, you can say, yes, this stable coin transfer from wallet A to B to wallet A to wallet B is settled, but it's not really accounting for the full end-to-end part of a transaction of getting money into a stable coin from fiat currency at a commercial bank, and then back into fiat currency in the destination jurisdiction in commercial bank money as well. And so there's a huge amount of I would say work that's required, whether it's in terms of providing liquidity and on-ramping or off-ramping back into fiat, but also the compliance aspect of that. And so I think there's fundamentally maybe some deltas that are maybe looked over a little bit too quickly. Now, I think on the stablecoin side, I think what is quite interesting though is more of a peer-to-peer type of model that's enabled, right? You can acquire USDC or PYUSD, whatever the stablecoin is, and you can transact peer-to-peer, and you don't necessarily have to go through a chain of intermediaries. So I think there are certain aspects of that model that are interesting that I think commercial banks can be looking at as we try and think around kind of an improved model of correspondent banking as well.
Mm-hmm. Yeah. So I guess one question for you, Jack, is, so as we think about this, and to tease out kind of some of the points, there's almost this question about how the market's going to develop. On one hand, is it going to be kind of a stable coin kind of model where there's an individual party in the center kind of driving things out into the market, or is it going to be kind of more collaborative, the way you kind of see correspondent banking working today, with lots of different partners all figuring out how to coordinate together? Like, how do you think about that?
Yeah, maybe sitting as part of SWIFT, my answer would be fairly obvious, but I think there's a huge amount of fragmentation that's going on in the market today, right? I think there's so many different technologies that people are using, whether it's banks or non-banks that are issuing different forms of tokenized value. There's a different set of standards that they're using, and so there's inherently a kind of a whole kind of host of fragmentation that's taking place, which then unintentionally has this paradox of saying, well, this technology is supposed to make things more efficient. But now we're actually getting into a world where it's actually exacerbating some of the inefficiencies. We're fragmenting liquidity across these different systems. They're siloed. They don't speak to each other. And I think that's one of these kind of natural byproducts of innovation cycles, where you start with a lot of the innovation. It allows different institutions to solve within their own walls very quickly, because they only have to be concerned with themselves, their customers, the commercial kind of incentives of their own institution, as opposed to trying to think around what do you actually need to align for a kind of true kind of ecosystem scale. The problem with the fragmentation is that as soon as you want to scale, you kind of really can't, right? There's limits to how far you can actually take that. I think it's a very kind of classic case of that old saying, if you want to go fast, go alone. If you want to go far, go together. And so I think we're going to be in a period of consolidation soon. I mean, you already see various consortia efforts from within the banking sector, public sector led, private sector led, that are meant to try and solve this from a commercial bank kind of proposition. And I think that's really the right direction of travel. But even then, I think today a lot of these are still a little bit fragmented, whether it's they're kind of regional or maybe have challenges in terms of like what's the true scale of those. And so, I mean, this is something that we're very focused on at SWIFT and with the SWIFT community of banks, to really try and bring a kind of a shared layer of utility for the banks to actually kind of coalesce and come around. And so it's, as you said, it's very much, I would say, an analog to how correspondent banking in the past was stood up, right? I mean, you have a kind of a cross-border network of trust that works really well at scale. Maybe there's a couple of inefficiencies that need to be improved on, but I think this is where the direction of travel needs to go, particularly for digital assets and tokenization as well.
Mm-hmm. Yeah, I think about the point you just made, kind of contrasting, right? Can you go faster? Can you go far? This industry is definitely going fast. I feel like I wake up every morning to a new announcement and a new vendor and a new infusion of capital. And I guess the thing that I've kind of noticed is right now there's almost like two parallel worlds, right? There's this there's the traditional banking world, right? And it's funny. We're in Florida. We're at a banking conference, and down in Miami, there's Consensus, which is the largest digital asset conference, and there's two very different conversations happening. And and one of the things I've noticed as I go to those conferences is also like the vendors are very different. So they're in kind of both conferences, they're talking about a lot of the same core issues. It's regulation, it's KYC, AML, BSA. How do we kind of deal with kind of that global requirements of being in the payments business, right? But what I'm noticing is the technology is often very different. The vendors are often very different. And it just kind of reminds me of maybe 15 years ago when the fintechs kind of came in and they started innovating a lot on customer experience, right? And it was, okay, we're going to build better front ends. And it kind of pushed a lot of traditional banks to improve their front ends. And you could argue that the feature functionalities were all there, but maybe the experience wasn't so great. So now I kind of look at this environment and I think about, going together, and, does that also mean kind of, is it time to kind of upgrade some of those core infrastructures? Not that all these new vendors are great, but, most of them are, they're there to sell, so it's hard to tell, but maybe, it's something for us to think about is this another moment like 15 years ago where kind of we're innovating and some of that back-end infrastructure can build for a better experience and better processes.
So just picking up on your point around technology, and if we look forward, like, people are using different technologies, but I think fundamentally a lot of the technology works. It's just more of a competitive kind of game around who the vendors will be. But I mean, so what do you see as the kind of path forward, and like, is there a path to scale? I think technology is probably not the problem. So what do you see being the challenge? Is it this kind of whole task of aligning people together? Is it around having very clear business case and rational kind of use cases that you can see like a payback period? Like where do you see the next couple of years? And I mean, I think we're probably still fairly early, right?
Yeah, so it's definitely hard to predict where the next couple of years will be. But what I can say with pretty good confidence, based on my experience in the payments industry, is building a new global infrastructure and rail is really hard and takes a long time. So a lot of those VCs aren't going to get the payback in the time frame that they might be hoping for. With that said, I think we're starting to see kind of initial use cases, kind of both offensive and defensive. Right, so kind of offensively, you're kind of seeing a set of options for cross-border payments that might meet needs differently than they do in the market. Right, it might not be every market, it might not be every corridor, but there's plenty of markets, especially in some of the supply chain markets, that aren't getting all the services they need from correspondent banking today. And so I think kind of this is an opportunity to either bring digital assets into the mix to better serve those corridors. So I think that's the biggest one that I see today. And then over time, there's an open question on whether programmability can kind of solve that holy grail problem of payments plus data plus process all in one place. And I think the investments around that are the ones that will build the largest business case over time. I think defensively, there's a real business case to be made for keeping deposits in the market. Deposits are the lifeblood of most banks, and services that can be built to make parties, both corporates and consumers, more likely to keep the deposits in the bank are always things that need to be done.
Yeah, I think I just want to pick up on one of the points you made as well around correspondent banking. And in this room, I think that the term correspondent banking, if you go down to like Consensus, like you were mentioning, or any other kind of digital asset forward environment, correspondent banking almost has like a taboo kind of feel to it. Like people start to get allergies, and they automatically assume that there's some bad aspect to it because of the kind of reputation it has. But I think fundamentally, even if you look at these alternative models that are being proposed, there's correspondent services that are being provided, right? Like you need some institution to provide liquidity into a foreign jurisdiction, for example. That is correspondent banking, whether you call it something or not. And so I think that's just something that the industry as a whole probably needs to kind of orient or align around and kind of challenge maybe some of either the misconceptions or the talking points that have gotten a little bit pervasive in the market. I think fundamentally, the functions will still exist. They might be repackaged in slightly different ways or provided by potentially new players that are looking to kind of step into that space. But something I thought that is worth talking about as well. I think we're about at time, and I think probably standing in the way of lunch. There was a few Slido questions, but unfortunately we can't see it anymore. So grab us offline.
Great. Yeah, thanks everybody. Hope you enjoyed it. Any questions, grab us offline. And yeah, we're the only thing standing between you and lunch, so go enjoy.
Great. Thank you.